Welcome to today's Explainer, where we're going to dive right into the massive milestone Bitcoin just hit. But listen, we are going to completely bypass the typical headline hype today. Instead, we're focusing entirely on the hidden institutional plumbing beneath the surface of the market. Because, it's incredibly easy to get distracted by shiny new all-time highs. But to truly understand where this market is actually heading, the real story is happening deep down in the infrastructure that supports those numbers. And speaking of shiny numbers, there it is, $80,367. It looks absolutely incredible, right? It's undeniably bullish, heavily fueled by continuous spot ETF inflows. But I've got to warn you, relying solely on price action right now is an exceptionally dangerous game. Just looking at the surface temperature doesn't tell us if the engine is running out of oil. And right now, the market's engine is undergoing a massive, foundational overhaul that most retail traders are just completely ignoring.
Which brings us to the core question of today's Explainer. Are you trading without a safety net? Because the Genius Act, which stands for the Guiding and Establishing National Innovation for U.S. Stablecoins, it literally just changed the rules of the game. If you don't intimately understand the new USD and USDC peg regulations, you are severely exposed. The reflexive upside of the old Wild West days, that's gone. It's been permanently replaced by a rigid, compliance-heavy framework.
So here is our roadmap for today. First, we'll look at the 80K illusion. Second, the anatomy of the Genius Act. Third, the hidden liquidity vacuum. Fourth, the stablecoin market war. Fifth, the flash crash risk. And finally, surviving the new reality. All right, let's jump straight into part one, the 80K illusion, high prices versus hidden plumbing.
There is a huge tension right now between surface-level euphoria and actual systemic health. It's a really stark juxtaposition. On one hand, institutional capital is flowing in rapidly. We're talking streaks of $767 million in weekly ETF inflows. But then, look at the broader market. It's trading nearly $67,550 below its M2 implied fair value. For those unfamiliar, M2 is a measure of the global money supply, basically cash and short-term savings. Historically, Bitcoin acts like a sponge for global liquidity, tracking M2 growth almost perfectly. So why the massive gap today? Well, because that institutional ETF capital is locked up tight in traditional brokerage accounts at places like Fidelity or BlackRock. It's effectively breaking the transmission mechanism for global liquidity, because that money isn't actually making its way on-chain, where it can provide deep, resilient order book liquidity.
Moving right along to part two, let's look at the anatomy of the Genius Act, because the rules have definitely changed.
To understand why that liquidity mechanism is suddenly broken, we have to look directly at the legislative catalyst. The Genius Act decisively ripped stablecoins out of a regulatory gray area and dropped them straight into the formal U.S. financial perimeter. It established super rigorous federal standards, mandating strict one-to-one backing with U.S. coins, currency deposits, or short-term treasury bills. And sure, while it provides excellent consumer protection, like prioritizing you, the token holder, if an issuer goes bankrupt, it completely alters how, when, and where liquidity actually moves across the blockchain.
Let's trace this creeping regulatory timeline, because, this didn't just happen overnight. The act was signed back in July 2025, which set the initial framework. By December, the FDIC proposed sweeping rules for banks. Then, the real hammer dropped in February 2026 with the OCC yield prohibition, and that aggressive move paved the way right into the strict, unforgiving enforcement of these revised rules by May 2026.
Let's unpack that February rule for a second, because it is literally the linchpin of this entire market shift. The OCC yield prohibition actively prevents issuers from paying interest to stablecoin holders. Now, why on earth would regulators step in to do that? Well, the answer comes down to a really deep-seated fear of a shadow banking run. The government looked at crypto platforms offering high-yield rewards on stablecoins and realized, hey, if everyday consumers start moving their traditional bank savings over to crypto exchanges just to chase those higher yields, it could trigger a catastrophic drain on regional U.S. banks. So to protect traditional deposits, regulators simply banned competitive returns on stablecoins. The ripple effect? It completely dismantled third-party yield arrangements, like that really popular USDC rewards program on Coinbase. Practically overnight, the financial incentive for everyday users to park their cash on centralized exchanges was just destroyed.
Which brings us to part three, the hidden liquidity vacuum and a massive structural disconnect. Pay really close attention to this contraction in exchange reserves. Just as the revised rules took effect, and right while Bitcoin was soaring toward new highs, stablecoin reserves dropped from $70.37 billion down to $66.37 billion. We are looking at a $4 billion contraction in reserves precisely as the rules were enforced. That's a drop of over 5%. Seeing reserves fall simultaneously with massive price appreciation is highly unusual. Normally, new money enters exchanges to buy the asset, but here, the money is draining out, signaling a quiet deleveraging event rather than a healthy, sustainable market expansion.
So let's formally define what this means. This is a liquidity vacuum. Think of it mechanically, like a car. Exchange reserves are the engine fuel required for market making. They're the essential dry powder, ready to support price dips or to aggressively fuel breakouts. But right now, because exchanges literally cannot incentivize holding stablecoins with yield, the fuel tank is actively draining. We are essentially driving a high-performance vehicle at top speed, but we're running entirely on fumes.
And to make matters even more precarious, consider this metric, 38,500. That is the precise number of Bitcoin that left exchanges in early 2026. That is a staggering 130% jump in outflows. Capital flight is actively compounding the liquidity vacuum. With both stablecoins and Bitcoin heavily exiting the exchanges at the exact same time, order books become dangerously thin. This makes the entire market incredibly sensitive to any large one-off reallocations or sudden sell pressure.
All right, moving to part 4. Let's talk about the stablecoin market war, onshore versus offshore.
We really need to methodically break down the major players right now. On one side, we have Circle's USDC. It's firmly domiciled onshore, fully compliant, boasting $18.3 trillion in transfer volume. Then, we have the industry giant, Tether's USDT. They operate largely offshore, way outside the grip of Western regulations, and hold more volatile assets like Bitcoin and gold in their reserves. And intriguingly, Tether actually launched USANT in 2026 through Anchorage. That one is backed strictly by federal HQLA, high-quality liquid assets, basically ultra-safe government securities, just to gain U.S. institutional access. What we are seeing here is a massive regulatory arbitrage, actively dividing the entire ecosystem into a safe but restricted onshore market and a massive loosely regulated offshore market.
And now we're at part 5. Honestly, this is the deepest, scariest part of the iceberg, the flash crash risk. Let me spell out the brutal truth of this systemic trap, because it requires your immediate attention. Despite these stringent new U.S. laws rolling out, the vast, overwhelming majority of retail trading volume globally still relies heavily on those loosely regulated offshore stablecoins, and that creates a terrifying systemic vulnerability. Look, in the traditional financial world, if a crisis hints, you have the Federal Reserve stepping in as the lender of last resort. But in the offshore stablecoin market, there is absolutely zero safety net. None. If the U.S. Treasury decides to strictly enforce these new rules tomorrow, say by forcing all U.S. regulated exchanges to completely block non-compliant stablecoin trading pairs, billions of dollars in unregulated liquidity could just vanish in an instant. It would trigger an instantaneous cross-border contagion, pulling the rug right out from under global order books before anyone even has a chance to react.
And this is exactly why that hidden plumbing matters so much right now. We are currently balancing on an $80,367 knife edge. But when we strip away the headline hype and dig into the raw on-chain data, we find a massive support gap directly below us, the true accumulation zone. The actual concrete floor built of solid historical buy orders sits way down between $63,111 and $70,685. If a sudden offshore liquidity withdrawal occurs because of these new regulations, the profound lack of dry powder on centralized exchanges means there are simply no limit orders waiting to catch the falling knife. We are literally risking a devastating 20% flash crash, plummeting straight down through thin air into the low 60s, purely because the market shock absorbers have been legislated out of existence.
Finally, part 6, surviving the new reality, law versus ledger.
I want to emphasize this core takeaway drawn directly from the research. The law now matters more than the ledger. The days of reflexive, unbridled upside driven purely by offshore leverage and raw code, those days are over. Institutional plumbing, regulatory perimeters, and strict compliance frameworks are what dictate market survival now. You have to actively understand the underlying architecture of where your liquidity is actually coming from.
So I'm going to leave you with this final, provocative question to think about. What is your actual exposure to offshore liquidity traps right now? The market is actively transforming into a highly regulated walled garden.
You need to take a really close look at the specific stablecoins and exchange bridges you rely on every single day, and make absolutely sure you aren't trading without a safety net. Thanks so much for joining me on this explainer, and remember, always keep questioning the mechanics beneath the milestones.